Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, we bring you a conversation with veteran market economist Ed Yardeni, the president and founder of Yardeni Research. I've been reading his work for years and highly recommend it. You can read it as well if you visit one of his websites, yardeniquicktakes.com. Ed, hello. Thank you so much for joining us today. We really appreciate it.
Thank you.
Now, there's so much to talk about today and so much positive stuff to talk about is what I'm hoping for here. And you have an excellent record of being both optimistic and correct, right?
Well, thank you for saying that.
So what I want to talk about today is where you see us going from here. We won't bother meandering around the past too much. I want to talk about the odds of something brilliant happening over the next couple of years and the odds of something awful happening over the next couple of years. And in one of your recent notes, and I will say, by the way, anyone who's listening who doesn't know Ed, I'm a very enthusiastic reader of all his work. And if you've been following me for a while, you will have seen him quoted everywhere. So you'll know a little about what he thinks already. So Ed, in a recent note, you talked about three possible things that could happen, three possible historical periods that the next few years could be like. And you mentioned the 1970s. I don't think we really want that. The 1990s, we wouldn't mind the late 1990s, would we? And the 1920s, which of course we didn't really have a roaring 20s in the UK, but you definitely had one in the US. So shall we start with the bad things that might happen, the bad decades we might follow? Then we can end on a high note, right? So what might be similar to the 1970s? You give that a 20% probability.
Well, the 1970s, from a macroeconomic standpoint, stood out as being very inflationary. And there's been a lot of concern that we may repeat that experience because back then we had two energy shocks in 1973 and again in 1979, and they both came out of the Middle East. And as a result of that, as energy prices went up, it spread throughout the economy. Energy is extremely important to the economy, clearly. And so it spread into wages, and from wages it came back into prices. And so we had a wage price rent spiral. People forget, but rent inflation was also a big problem in the 1970s. Well, it could be deja vu all over again in the current decade. It doesn't feel like it to me right now. Because inflation has come down dramatically, but it came down dramatically in the 1970s following the 1973 shock. And then when we got hit again, and it's conceivable given that the Middle East once again is boiling and that there's a potential, not a potential, but it sure looks as though a lot of the conflicts are spinning out of control. If that starts to affect the price of oil and pushes it up dramatically because of supply disruptions caused by the conflicts over there, then it would be very similar to the 1970s again. And so I think it's certainly a possible scenario given the way things are going over there. But what's interesting to me is while the news has been awful, the price of oil has been remarkably tame, subdued. It's down still sharply from its peak of last year in September 27th. And that's despite the war between Israel and Hamas and the escalation of tensions by Iran's proxies in Syria, Iraq, Yemen, and so on. And of course, the disruptions to Red Sea shipping. So put that all together and we've got a geopolitical crisis, but so far the price of oil has been remarkably tame. And I think that's because China's in a recession, Europe's in a recession, and but the U.S. is doing pretty well. So all in all, from an economic standpoint, so far so good. From a geopolitical standpoint, not so much. It's quite a bad situation.
Yeah, and there's still a chance that putting oil aside, the disruption to shipping through the Red Sea could have implications through the supply chain, and we could have an inflationary impetus from that, regardless of the oil price.
Well, it's, so ships aren't going to the Suez Canal. And then from what I understand, there's an issue with the level of the Panama Canal, which has also reduced the ability to get a lot of ships through that way to other routes. So, yes, I think you're absolutely correct in bringing that up.
I mean, it is one of the things that we worry about relentlessly on this podcast. We worry about inflation a lot. I mean, there was a similar point in the 1970s of where we are now when everyone went, well, inflation is dead and that's that, it's all fine, and behaved as though it were, when of course it hadn't actually been destroyed, and back it came and in spades twice.
I think what's different this time is that the Fed is much more sensitive to inflation. It took them a little while to recognize that it was a problem in 2022, but they scrambled and they, I think, went from behind the curve to ahead of the curve, the inflation curve. And so I think the Fed's credibility on fighting inflation has actually improved quite a bit. The other thing is I think we've discovered that quite a bit of the inflation we've experienced has turned out to be transitory and has been very much related to the pandemic and the supply disruptions related to the pandemic. And so far, those disruptions were much more widespread and much more inflationary than what we're seeing so far in the current situation.
Yeah, it's hard to write it off, though, isn't it?
Yeah, I give it a 20% subjective probability. So, and then there's two other scenarios.
Exactly. And I was going to say that what he said the other day, Grant Schnaps, is we are moving from a post-war world to a pre-war world. And, nothing is a forerunner of inflation more than war. It's pretty much always a leading indicator of inflation coming. So
wars are inflationary. Wars are definitely inflationary historically.
If inflation were to come back, it's already coming back, numbers are slightly higher than expected in the UK this week. It's hard to see rates coming down in the way that most people seem to expect, isn't it?
Well, it becomes the 1970s again. The scenario there was that Paul Volcker came in the late 70s and basically decided that he had to let monetary policy wreck the economy in order to bring inflation down. And that's been sort of the key thought process of pessimists since 2022, since the Fed started raising interest rates. The basic concept was that there's no way we're going to bring inflation down without a recession. Historically, it typically takes a recession to bring inflation down. But I think one of the reasons that hasn't happened is because the Chinese and the Europeans have done us a great favor. They've had a recession. And because of particularly the recession in China, there's been falling goods prices. So we still do a lot of business with China, and this certainly had a deflationary impact on the global economy, and particularly the U.S. So we didn't have to have a recession in order to bring inflation down. They did it for us.
Yes. It's given us what is it you who calls it immaculate disinflation?
Right.
Yeah, it's given us that. We've been very lucky. Okay. So that's a 20% likelihood, but pretty much everyone else who comes on the podcast gives it about an 80% likelihood. So we're already moving forward nicely with the optimism here. Thank you. The second possibility that you actually only quite recently started talking about it as a distinct possibility, which again you give if 20%, is the late 1990s, which weren't bad at all until 1999, 2000, when suddenly it got bad. But the late 1990s, they were a hoot, right? That wouldn't be all bad.
Well, speculative bubbles are wonderful as long as you remember to get out right before the bubble bursts. You can certainly make a tremendous amount of money in a very short period of time. But you can also lose your mind and conclude that, it's a new era and everything is just amazing and it's going to be amazing forever. And then not only do you keep speculating, but you leverage the speculation. So there's a potential for irrational exuberance similar to what happened in the late 1990s. And all of a sudden I'm seeing a lot of similarities. NVIDIA is a great company. I don't recommend to buy, sell, or hold individual stocks. But it is an amazing company. I mean, they went from making a lot of money selling chips for gaming to selling a lot of chips for mining Bitcoin. And then suddenly they were the only people selling picks and shovels for the gold rush in artificial intelligence. So the company's stock price has just kind of gone straight up, especially since OpenAI introduced ChatGPT in November of 2022. And the stock's been hot, but so have other stocks like Microsoft. Anything that's remotely related to artificial intelligence has been really off the charts. And I'm struggling whether it's hoopla or hype. I think it's some combination thereof. I think it's going to take a while before AI makes a huge difference to our economy. But I think it'll make some difference. And meanwhile, there's a lot of other technologies that I think will be very good for my base case. But for this scenario, the similarities are, a tech bubble, tech-led bull market that becomes increasingly narrow, focused on the large cap companies that are likely to benefit. Back in the late 1990s, the stock that really took off was Cisco. And Cisco makes a lot of equipment for the internet. And the stock went up eightfold from 1997 to 2000. And then it collapsed for all sorts of reasons. But the reality is internet certainly continued to proliferate. But I think the reason Cisco collapses is because everybody bought their equipment, partly for the internet expansion and partly because of the concerns about the Y2K problem. And so when we crossed into the new millennium, companies had spent a tremendous amount on redoing their technology, and then suddenly all that demand kind of vanished at the turn of the clock. So it's conceivable that we could have that kind of scenario. We're maybe in the early phases of it right now.
But to get into that kind of melt up, would we need to see rates falling fast? So we'd need to see everyone getting concerned that inflation was going to fall to 2% or below, and then we'd need to see actual rate cuts come through from the Fed at least.
It's a fascinating scenario to think about because, put yourself in the shoes of Fed Chair Jerome Powell. He's just more or less said that they're done raising interest rates, that it's restrictive enough. And he and a few other Fed officials have said, if we do keep making progress on bringing inflation down, we will have to think about lowering the Fed funds rate, because if we don't do that, then the inflation-adjusted Fed funds rate will actually be going up. And so we don't want to be more restrictive than we are, so we might have to consider lowering rates. So just having said all that, the markets have had a tremendous rally. I mean, we're up 35%. Since the bottom of the bear market back on October 12th, 2022. And a lot of that has been led by technology, which is very, very much of a high beta sector. That's the best leverage way to play an economy that's growing without interest rates going up any further. And if the market starts to sense that the Fed really is about to cut interest rates, imagine how much higher things might go. So, I think Fed Chair Jerome Powell knows all that, and I think he might very well start to push against it and say, you know what, we're actually not in any rush at all to lower interest rates. Look, the economy is doing well. Inflation's coming down. What's the rush to lower interest rates? Nevertheless, if the Fed becomes less relevant because we're not spending nights and days wondering how much higher they're going to take interest rates, the markets can focus on the fundamentals and on the hype. And right now, the fundamentals look awfully good for the economy, and there's plenty of hype around about AI.
Yeah, it feels like it would be a great shame for the Fed to start cutting rates aggressively again when they've finally got them to a level that feels historically normal.
I agree.
So unless there was a whopping great recession, it would make sense, surely, for central bankers around the world to go, thank God we have an opportunity to normalize here. Let's try and stay somewhere around 4%, because that's roughly where they've been for the last 3,000 years, and it's kind of worked.
Well, I think you make an excellent point, is that in some ways, while we all know that the central banks have been tightening, they've also been normalizing. We had a very abnormal period from 2008, the great financial crisis, through the great virus crisis in 2022, where central bankers were just obsessed with bringing inflation back up to 2%. Those were the days, right? And so they put interest rates at zero. They had quantitative easing, quantitative tightening was not something that they envisioned at all. And at the same time, some of them had negative interest rates. So we're kind of back to normal. So why not leave it that way for a while? What's the rush to lower interest rates? And if they do lower interest rates, then they really have a risk of, instead of worrying about price inflation, they may have to worry about asset inflation.
And then, of course, if they do cut again when we're not in an actual recessionary situation, they've got nothing left if we do move into another nasty period. Can I ask you, as an aside, Ed, do you have any thoughts about where the 2% target came from and whether it's valid? We spend a lot of time on all our podcasts and all our articles talking about 2% and the importance of 2%. And John and I have traced it to a paper written in New Zealand a couple of decades ago, but we can't go back. Yeah. And that's it, right?
I think you're right. I think that New Zealand was the first central bank, or among the first, to have an inflation target, and it kind of caught on. It became sort of an obsession with macroeconomists that maybe if the Fed targeted some very low inflation rate, we could have nirvana. And you might recall there was a description of a period there in the 80s and the 90s that was called the Great Moderation, that the central banks had figured out how to calibrate their policy so that inflation would be very low, very moderate, and the economy would continue to grow. And it looked like a pretty good scenario until the central bank started to go wild about deflation, being terribly concerned about deflation. And suddenly they became obsessed about getting inflation up to 2%. I had no problems with inflation below 2%. Personally, I mean, I think most of us who had jobs, and most people did have jobs, low inflation is a good thing, and zero inflation is fine. But they were paranoid that if it got down to zero, my God, it could turn into deflation. You just need a little bit more cushion. So it's kind of nonsense, quite honestly.
Okay, good, because that's what I thought, that it was kind of nonsense. So I'm glad to hear you confirm that. Of course, that period you talk about, the Great Moderation, that was the period when our Chancellor told us he'd abolish boom and bust, which we all went, not sure about that.
Well, it gives them something to do. They can write papers about it and then try to implement policies to achieve that target. I guess it's a way to sell their importance, but I think the central banks have become way too important in our investment lives and our business lives because they are so meddlesome.
And we also, I mean, if you look at the way that inflation has come down over the last year or so, it's not a given that is anything to do with central banks anyway. They're very good at claiming credit, but you could say that the previous period of disinflation was nothing to do with them, and the inflation was something to do with them, what with the frantic money printing. But that coming down again wasn't necessarily anything to do with them. Well, a lot of taking credit where it might not be due.
You and I should go on a road show because it seems like we agree. And I'm sorry, I don't mean to finish your sentences off, but I'm inspired by the spin you're putting on things, because it's the same spin I've been putting on. Is you've got to be empirical, you've got to be data dependent. They keep saying they're data dependent, and yet they come up with these cockamamie theories that they try to force the data to fit. But you're absolutely right. I think we've learned that inflation isn't just a monetary phenomenon. I won't say that it's not a monetary phenomenon, but it's not just a monetary phenomenon. There are a lot of moving parts there. And I think historically, when you look at inflation, it tends to be very spiky. The faster it goes up, once it peaks, it comes down almost as fast, and it does tend to be spiky. The 70s was actually an aberration. And again, I think a lot of that had to do with the geopolitical crises in the Middle East.
That's why we need to keep an eye on those geopolitical crises we've got at the moment. Right, shall we move on to the good bit? The good bit, the bit that you give a 60% probability to, the roaring 20s. And John and I have been really, really hoping for a roaring 20s. We started talking about it, I think, when you first did. We read that and we were like, yes, that's what's going to happen. That's what we need. And since then, there's been kind of precious little sign of a roaring 20s.
Well, at the beginning of the decade, I did start to think about the possibility that the 2020s could be like the 1920s. If nothing else, it kind of rhymes. And they do say that history doesn't repeat itself, but it does rhyme. And it was interesting that in the 1920s, before the 1920s, there was a horrible war. It was called the Great War. They didn't have World War II to call it World War I at the time, and it was horrible. And not only did people die from the war itself, but then because of all the diseases that the soldiers gave one another in the trenches, we had the Spanish flu in the late in 1918, 1919. And so we had a pandemic, we had a war, and in the United States, and I think around the world, in 1920, there was a recession, and back then they still call these things depressions. So it must have been pretty depressing to think about the outlook for the 1920s at the beginning of the decade, and yet it turned out to be the roaring 1920s because of technological innovations, things as high tech as plumbing, the auto, manufacturing adopted the more efficient ways of producing things, and as a result of that, we had a tremendous productivity boom. And productivity is a wonderful, wonderful economic variable, because the more you can get productivity to grow, the more output you get per worker. By definition, you get less inflation. You get wages rising faster than prices, because workers do tend to get paid their real wage in productivity. And so it was a great period. It ended badly in 1929, 1930, though I point out that it was not because it wasn't the economy's fault. It was because of the Smoot-Hawley tariff, but that's a whole nother subject. But so there are similarities now. We've had a pandemic. I think we've got a technology revolution that started in the 1990s. It was fairly crude back then. If you could replace secretaries with Selectric typewriters, who were on Selectric typewriters with Word, or if you could replace a lot of bookkeepers with Excel spreadsheets, then you could increase productivity. But the technology wasn't all that applicable to businesses across the board the way it is now. I think now every company is a technology company. You either make it or you use it. If you don't use it, you're going to lose it. You're going to go out of business. So there's a lot of pressure on companies to use technology to increase productivity, particularly since there's a chronic labor shortage. So you put that all together, and I think we're in the early stages of a productivity growth boom. And I think it's already sort of been, the data is already there to show that it's happening. Back in 2015, on a 5-year trailing basis, the productivity growth rate was 0.5% at an annual rate. So in the 5 years prior to the late 2015, it was only 0.5, close to zero. And now the number is 1.8% on a comparable basis. So that's a tripling of productivity growth. I think it's going to go to 3 to 4%, which sounds delusional, if maybe far-fetched, but that's the kind of productivity growth we've gotten in the previous 3 productivity growth booms. And I think this one, the technology lends itself to increasing productivity in just about every business I can think of.
It's interesting, isn't it? And that there are an awful lot of people who spend their entire time worrying about falling populations, about lack of labor, about demographic pyramids, etc. But if you look back in history, some of the greatest periods of productivity growth have come in periods when the labor force has been shrinking quite fast rather than rising, because that's when there's enormous pressure on people to create the innovations that will keep things going. And I think the dynamic is the same in the US, but certainly in the UK, we hear constantly about how we must have more and more people. We must replace the disappearance of our own workers with constant immigration, because that's the only way the economy will keep going. But I tend to feel, rather as I think you do, that is this shortage of labor that forces innovation, forces creativity, and forces productivity. I mean, after all, the UK population has been increasing very fast over the last decade or so, and it's done us very little good at all. GDP per head has been flat, very slightly rising, but certainly doesn't reflect anything particularly good. So I'm very much with you on this one. And if you look, for example, at Japan, there's, in fact, I think one of the newspapers had a big piece earlier this week about Japan and the amazing innovations you see there in terms of robotics and AI to help deal with the falling population.
Yeah, I completely agree with that.
And if one of the things that we've been worried about, both in the US and in the UK, possibly across Europe as well, has been low real wage growth. This productivity boom that will finally push up real wages and finally give us some sense of a shift in the income inequality dynamic. Well, I mean, sounds wonderful.
Absolutely. Look, on real wages, I've actually been pointing out that the data shows that wages divided, average hourly earnings divided by the price deflator, which is the best kind of monthly way to keep track of real wages, they've actually been growing since 1995. The period of stagnation was prior to that, particularly during the 70s and the 80s, because of deindustrialization, because of globalization, taking jobs away from Americans and others. A lot of jobs went to Japan in the 70s and the 80s, and then we saw China coming in to the global economy. But the reality is, the data shows that real wages have been increasing at an annual rate, on average of 1.4% since 1995. So the reality is, workers collectively have actually seen their real wages going up, and that compounds pretty nicely. Now I think we could see real wages growing even faster than that because of faster productivity growth. There's a very close correlation between productivity and real wages, so I'm optimistic on that score. And as you said, there's a shortage of labor, and when you've got a shortage of labor, you've got to pay a higher price for it. And the only way that works without causing a wage price spiral is if productivity does in fact make a comeback. And I think that's what companies are scrambling to achieve, and I think they are achieving it.
Back to the ETFs, do you worry about the effect of the rise of passive investing on the market? I mean, one of the things that you write about a lot is the Mega 8 or the Super 7, however you like to look at these huge technology stocks. And one of the things that has pushed their prices up over and over and over is the momentum that comes from money continually pouring into index-based ETFs. Is that a long-term problem for markets?
Well, I think it can be a problem during bull markets. Obviously, it can kind of feed on itself. The problem with ETFs, with passive investment, is that people just pile into indexes, and if they all kind of pile into the same indexes, then you wind up with a potential concentrated market with just a few stocks doing very well. Active managers typically aren't going to put more than 2% of their portfolio, maybe 3% of their portfolio in any one stock. They tend to diversify. They don't put all the eggs in one basket. But the ETFs, of course, can have much more weight in just a few stocks. So we have what I call the Mega Cap 8. Others call them the Magnificent 7. I watch a lot of movies, so I want Netflix to be in that composite. And the Mega Cap 8 now account for something like 27, 28% of the share of the market capitalization of the S&P 500. And very few active investors are going to concentrate their portfolio that much in a handful of stocks, much to their chagrin, obviously, because that's where the performance has been.
Because they're always underperforming as a result. Okay, so let's go back to the roaring 20s.
Sure.
Hopefully this is excellent for stock markets, right? It's not quite the melt up, but it's a better, longer term bullish case.
It's a better, longer term bullish case from a fundamental perspective. The risk is that everybody else, besides you and me and a few others, kind of joins the party here. So, I think, didn't Prince sing a song about let's party like it's 1999? So
yep.
I
Top
think,
favorite.
Yeah. So I think that the 1920s is great for the fundamentals. It's great for productivity and real wages and prosperity. Hopefully the stock market just doesn't get too ahead of it.
The stock market does pretty much always get ahead of things, and it's already possibly a little ahead of itself already. I mean, it certainly smashed through your forecasts at the end of last year, and I don't know if it's smashing them already this year, but can't be far off.
I have to tell you, I do talk to people in the press on a fairly regular basis, and I had an interview recently with a young fellow from a Korean newspaper, and I thought we were going to have a pretty broad-ranged conversation, but he kept coming back to, he said to me that retail investors in Korea are very excited about artificial intelligence. How can they play it? And it just dawned on me that it's a big world out there with lots of people playing the market. And if this really catches on a global basis as like a really hot place to be, then it could turn into the 1990s. But even if it does, it's not the end of the world. I mean, we had a tech wreck in the stock market in the early 2000s, and yet we're well advanced beyond that in terms of real GDP is at an all-time record high, real consumer spending all-time record high, standard of living have never been better. I know people argue with me about that. But the reality is, even if we have a speculative bubble in stocks and tech stocks and it bursts, it's probably not going to change the course of progress that would be made fundamentally in a 2020, in a roaring 2020s kind of scenario. As I mentioned before, Cisco was a hot stock in the late 1990s that crashed in early 2000s, but that wasn't because suddenly somebody slammed the brakes on internet. Quite the opposite. The internet has become, ever present in our lives.
So we can have, and it would be all bad, we could have a roaring 20s and a late 1990s at the same time.
Absolutely. So 60 plus 20 is 80%. So I guess I'm quite bullish.
You're very bullish. I'd call that extremely bullish. Okay, so here I am. I'm a retail investor. I'm an ordinary person in the UK or the US. I'm listening to your talk and I'm thinking, this is fantastic. Merryn's finally got someone on who's positive about stuff. What should I buy?
Well, I think that what they do is kind of go with the underlying fundamentals. So the underlying fundamentals, I think, are positive, particularly in the U.S. I would overweight the U.S. in a global portfolio.
Would you, even at these valuations, even though it's significantly more expensive than most other markets, you'd still overweight it?
I've been favoring what I call a stay home over a go global scenario since 2009, 2010, and it's worked pretty well. I guess at some point I'm going to overstay my welcome there. But for example, I've been opposed to investing in China. I just don't think it's a good place to invest from the point of view of the political intervention by the communist government in the economy. So I've been down on that.
Very right there.
India's been a great place to invest, but talk about a bull market. I mean, that's been a very hot market. So when you actually go around and look for places that are cheap, some of them are cheap for a good reason and aren't necessarily going to turn around. I guess you could look at Vietnam, which is actually still viewed as a frontier market as opposed to even emerging market. That's, in other words, it's still a little on the dicey side. Mexico is a big beneficiary, I think, of deglobalization because production is going from places like China to Mexico, closer to the United States. But the United States, in some ways, is an emerging economy, believe it or not. We're seeing a tremendous amount of spending on onshoring, on bringing manufacturing back to the United States. We have an extremely diversified economy. If you want tech, it's hard to get. I don't know that there's really any companies comparable to the mega cap 8 around the world. I mean, Samsung, maybe Taiwan Semi. I mean, there are clearly some great companies around the world, but in terms of leading edge technology, a lot of it seems to be here in the U.S. Maybe we come up with a lot of the concepts and then we produce the concepts somewhere else. But yeah, I would overweight the United States, even though it's not cheap. What's really not cheap, of course, is the mega cap 8. And that's where the potential for a 1990 scenarios come in, is that everybody kind of gives up and says, all right, I didn't get into these stocks. I just got to get into them. And everybody that has missed it gets in at the top. But I would say technology, finance, industrials are the areas of the market that I've favored. My problem in giving advice these days is it was better advice near the bottom, which is when I actually did turn bullish back in October of 2022, about 2 weeks after the market bottom. So there was a lot more value there. But small and mid-cap stocks have actually been very frustrating for me because they've looked really cheap for a long time. And suddenly they finally caught on since October of last year. I think once the market started to believe that the Fed was done raising interest rates, the market started to broaden. And then just recently, it started to narrow again. So it's been kind of a tricky game to play. But I think if you're looking for some really good values, there's a lot of small cap, mid caps areas of the market. And again, I would focus on technology, financials. Biotechnology has been doing better. So there are opportunities for sure. But as always, work with a good financial advisor that you feel comfortable with, that knows what your needs are and can help guide you.
Now, in that little run around the world, we covered India, we covered Mexico, and we covered pretty much everywhere. You did not mention either Japan or the UK, both markets that a lot of people would say are fundamentally cheap. And while they might have difficulties, are both cheap and jammed full of fairly interesting companies. But neither of those have made it onto your radar.
Yeah, well, we were just talking about emerging economies, which is why I kind of mentioned them. But developed economies, obviously, in terms of global aggregates, stock aggregates include, of course, Japan and the UK. I've got no problems with investing there. Japan has been actually on fire, so it's not as though we're discovering something that nobody's knows about. Quite the opposite. It's been a very hot market indeed, and the UK as well. I'm just saying.
No, we haven't been on fire. No hot market here. Nothing on fire, I'm afraid.
Yeah, well, maybe that's.
We just stumble along.
Yeah, maybe there are some opportunities there. But look, I think Europe, generally speaking, has a demographic issue. It's aging rapidly. I mean, there has been a lot of migration, but maybe all this migration that's occurring, it's unsettling. It's can be destabilizing politically. But history shows that immigration is actually a source of economic growth if there are good incentives for people who are looking for a better life to actually do that on their own rather than to depend on the government for a better life.
Yeah, well, the immigration interaction with the welfare system maybe makes now different to historical environments that have been the same. Who knows?
Right now, it's more destabilizing politically than it's stimulative economically.
Okay, well, let's not move into non-jolly conversations because we're being optimists here. Remember that? No, we're very much sticking with our 80% bullish scenario here. But I have two really important questions from here. And the first is a question that we ask everybody who comes on the podcast. So an answer is compulsory. Okay. If I said that you could only have one of the following assets, and we can argue about whether they're assets or not, for 10 years, nothing else, just one of these, which would you choose? And you get to choose between gold, Bitcoin, or a deposit account, straightforward savings account, cash, basically.
Oh, I don't get a choice of buying equities or bonds?
Nope. That's not how the game works. That's not how the game works.
Oh my God! And I have to make a choice of those three. Oh well, then if you put me in that kind of world, what the heck? I'll take a run on Bitcoin, though I know almost nothing about it, and I've not been a fan of Bitcoin because it doesn't pay a dividend. It doesn't pay interest. From that perspective, I guess it should be in deposits if they pay interest. But if you tell them,
you get interest.
If I do get interest on that asset, I put half.
Okay, half in cash, half in Bitcoin, and we're not going anywhere near gold. No gold?
I think Bitcoin's sort of become the new gold. So, if I'm going to be both conservative and speculative at the same time, I'll take my chances in half in deposits and half in Bitcoin.
Excellent. Digital gold it is. Okay, thank you so much. Now, one last question, and this is slightly off topic, but how did you train your dog to be so well behaved?
Well, they're King Charles Cavaliers, and we've got 3 of them, and they're couch potato dogs. They sleep a lot. They're wonderful members of our family. Okay,
well, I wish we'd had this conversation last week because while your dog is meandering around sweetly and obediently in the background, I've got an 8-week-old border terrier puppy downstairs that I can hear yapping right now, and I hope you can't hear rapping. So I wish I'd gone for a spaniel. That's a bit of advice I could have done with earlier. Ed, thank you so much for joining us today. It's been wonderful talking to you.
My pleasure indeed. Thank you.
Thanks for listening to this week's Merryn Talks Money. We'll be back next week. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to your podcasts, and do tell your friends. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi, additional editing by Blake Maples. Special thanks to Ed Yardeni. And I know we always plug John's brilliant newsletter, Money Distilled, at the end of the show, but this week we're giving you a heads up on a newsletter that is launching next week, The London Rush. Sign up to get briefed ahead of your morning calls with the latest UK business headlines, key data and market reaction with Bloomberg UK's new morning newsletter. Link is in the show notes.